Hey there, Rick. How are you doing today?
Fine, Joe. How are you?
Good, good, good. Thank you again for joining me one more time and sharing some of your information. If you don't mind, for those people watching this video right now, giving a quick reintroduction of who you are and what you do.
Well, thanks, Joe. So, in the Bay Area, we have seen real estate values go up dramatically. And if you've owned your property for a while, whether it's your home or an investment property, you're sitting on a lot of potential gain, big tax hit if you were to sell it. I help people find access to that money tax efficiently. I'm a certified financial planner. My firm, Lifetime Legacy Services, builds on my experience as a CPA and as having been the chief financial officer of a major real estate investment company. I help people knowing that how to build plans, make decisions that help them live the life they want. In particular, finding ways to free up the cash if they don't have as much cash coming out of their investments as they want.
That makes sense, and that's very helpful. Thank you. I guess on that topic, one primary example or very common thing that I hear oftentimes when I'm talking to people, I meet with a lot of people, I speak with a lot of people who are considering selling their homes, maybe bought their home 30, 40 years ago for sometimes a tenth of what it's worth today.
Right.
So, a common example might be, hey, we bought our home 35, 40, 45 years ago for $200,000. And today it's worth somewhere in the range of $2 million to $2.5 million. Yes, of course, we can take advantage of the $500,000 exemption or home sale tax credit or whatever you would call it that adds $500,000 to the cost basis. But that still leaves over $1 million of gain that we would have to pay taxes on. So I guess what information or what help or support can you give to somebody maybe in that situation?
Well, let me tell you what my wife and I have done, because we are in that situation, having a very low assessed value, which is very nice to hold on to. So what we did is we converted our home to an income property and then went out and bought another home for our primary residence. And so what that does for us is now we have more options available. If you just have if you own your home, if it's your primary residence, you really don't have the income property alternatives that are available. So what they call is a tax exempt, tax deferred exchange, a 1031, where you can take the money out and buy another property, exchange it for another property, and you don't have to reflect that gain. The other thing that you can do is there are different forms of that. One is just to actually buy a property. Many people find where you just have like I don't know, Starbucks or McDonald's or some type of franchise where you get them paying you what they call a triple net lease. The other thing is to go into where they have a bunch of properties that they hold in what's called a DST, a Delaware Statutory Trust. And there's even the chance of having it go into what they call an UPREIT, where you all get shares of a REIT. But those are different things you can do. And then there's another alternative if those are not generating enough cash that I talk to people about.
So basically what you're saying is that they're able to buy another property that they move into that becomes their primary residence. And then they turn their current property into a rental property. They rent it out to somebody, in other words. They rent it out long enough. I think that long enough is probably vague in the tax code.
I think it's a 2-year window before and after.
2 year. Okay. So they rent it out for a couple of years, about 2 years, and then sell it. And then they can do a 1031 exchange and defer their taxes, paying taxes on the capital gains there.
Correct.
Okay.
There are some very restrictive rules around that. You have to be careful how you do it, but it's effective, very effective.
And I guess you probably work with a good amount of people here in the area. What are the common things you see people doing, or what would be probably some of the more common strategies that you see people doing out of the ones you mentioned?
So the one that, if you're really inclined to move into an income property, then really the going into what they call triple net lease, credit tenants, whether or not it's a Walgreens, a CVS, some sort of other, retail operator owns you own the building and they pay you a net rent. That's a credit tenant. That's one thing that is probably, depending on how much money you have, something you can do. If you want more diversification, go into more properties. Then you go into some of these other pools. I have concerns about that because those are getting back into limited partnerships type structures where someone else controls the decisions. One of the reasons most people are successful with their real estate is because they control those decisions. So that gets it's a little bit different deal involved, higher risk because of that.
And are you referring to DSTs?
Right.
That?
DSTs in particular, right. The other one is tenants in common ticks that they were popular, a decade or so ago.
DST stands for Delaware Statutory Trust.
Correct.
Do you mind giving a little bit more information on, I guess, what those are? Because not everybody might be super familiar with those.
Yeah, so that's a pool of property. So you would actually contribute your property to the trust, and then it would be included with properties others have also contributed to the trust. And then there are restrictions on what the manager of the trust can do, but over time, they may trade into another one, or to further extend it, or they can sell properties off, and they would over time bleed off your capital gain. But there are rules about how much they can distribute when, and other things about how they assemble their portfolio. If you're the first one, you'd have to consider it a blind pool because you don't know what other properties are going to be added. If you're the last, you'll know what you're being combined with. But then the challenge is what happens next, and the manager has control over that. You wouldn't.
I would say one of the primary issues that people face is that the only money they have or the only wealth they have is tied up in their house. So they're not able to buy another property or, move anywhere else and make that their primary residence. They need the money from the sale of their home. So one common example that I have, because I work with assisted living facilities and seniors moving into assisted living facilities, they need the money from the sale of their home in order to pay for that assisted living facility. But again, they oftentimes have more than $1 million of gain that they would have to pay capital gains tax on.
Yeah, so the things that I've seen that might be involved, depends on how much you really need, is what's called an installment sale. So you can recognize the tax over time as you get the money in. And you may be able to make an arrangement with the facility on how you would pay in over time. So that may balance it out. What that would do for you, it would help stretch out the impact of that tax. Otherwise, it's a real challenge. The exclusion, the $500,000 exemption is really the only thing that's there when it's your primary residence. Otherwise, I'm not, and these installment sales, I'm not sure of other things that work today. They've changed the tax code so much.
Yeah. So, well, as far as the installment situation, is that something you see people taking advantage of?
I have not directly been involved. I'm aware of that. In all these cases, what I try to advise people on is how to do it in a way that manages the risk. You know what you're getting into, and it's going to work for you the way you want it to. And so a lot of these, if they involve third parties and it's a private deal, often you're giving up control that I'm not necessarily comfortable with, but it depends on what your situation is, on how much you need to go into one thing or another, and whether or not that risk is necessary for you to take on.
Because I think that, somebody who is moving into an assisted living facility, for example, they need, oftentimes $10,000, $15,000, $20,000 per month for the care, to deal with the care, to deal with the facility itself and things like that. And they don't necessarily need like $2 million in the bank right away. And so something like that would work for people. But I guess what you're saying is, where does that money go after the sale in order to be paid in those installments? Is how much control do you have over that, and what the risk reward
and who you're dealing with, who the counterparty is, and how well establish how well protected you are in the circumstances.
I think about 10 years ago was the first time I heard of something like that, and saw somebody make a presentation about it at our real estate office. But I think also since that time, I've never actually seen it being implemented. Why isn't that a more common strategy then? Because that does seem like it would be a good alternative to a lot of people,
It really is a matter of the circumstances people have and whether or not they can structure it in a way that's going to work.
That makes sense.
My experience with everyone in this industry, in the field, is you really have to understand who they are and what I call what their business model is, to understand really is that if they're selling you something you can really rely on to perform the way you want it to. And that's one of the biggest challenges I think we all face.
Okay. And so, what are some ways or what are some things you can do in addition to this? Let's say it is somebody who is able to buy a property or maybe move into a rental property themselves. They rent out a property that turns into their new primary residence and then rent out their old property. That could be an alternative as well, right? Rather than buying. Either way, whether they buy their own property that turns into their primary residence or they rent out one, what kind of services do you offer and your company offer that might be able to help them?
Well, the number one thing I think is involved with all these is about making important decisions. And the core of what we do is help develop a plan, a framework for making important decisions. So it's very tailored to the individual circumstances to see and have a meaningful dialogue so that you really can achieve what you want. Because of my orientation, I think that I have a broad spectrum that we will bring to the table. So it's not really pushing a given product or a given approach, but really trying to tailor it to the individual. I think that's the number one service that anyone would really benefit from. Going beyond that is then knowing how to look at investment properties if you want to go into an exchange or something like that, or also what the best ways, if you want to diversify into other types of investments, what are the best ways and how to manage those risks. That if you have follow-up questions that you want to ask, or some of the people you work with have those kind of questions, I'm available. I love to help people. That's why I do what I do.
On that note, what is the best way that somebody can reach you if they do have some questions or if they want to talk to you about helping them with their situation?
Well, the best thing is to go to my firm's website. It's lifetimelegacyservices.com. It's spelled out the way the words sound. And on there, you can book an appointment with me. It ties into my calendar, so you can schedule something. We can do a quick 15-minute call just as an introduction, see if it makes sense to talk further.
Okay, perfect. That sounds great. And we'll make sure that we put that into the description wherever somebody's watching this video. Right. So they can easily reach out to you.
Thanks. Joe, it's been a pleasure.
Okay. Thanks so much, Rick. I appreciate it.
Take care.